Welcome everyone to the first meeting of 2012 of the MPC, and I trust that you all enjoyed the festive season and have returned to work refreshed and full of energy. We're going to need it this year, I think. Allow me first of all to introduce Francois Groep, the newly appointed Deputy Governor of the South African Reserve Bank. Welcome, and I'm sure that as we work through the year, we all look forward to a long and productive working relationship with him and yourselves, and no doubt you'll get to know him better as the year unfolds. I would also like to apologize for the absence of Deputy Governor Daniel Manele, who had to leave to attend the G20 meeting, the deputies meeting in Mexico City. If there's one word that captures the prevailing global environment, it's uncertainty, which we are all learning to anticipate, analyze, and interpret in a rapidly changing world. Since the previous meeting of the Monetary Policy Committee, the outlook for domestic inflation and economic growth has deteriorated, posing a serious challenge for monetary policy going forward. Inflation is now expected to remain above the upper end of the target range for a more extended period, but there is still no evidence of significant demand pressures in the economy. While economic growth in the fourth quarter was likely to have exceeded that in the previous two quarters, the forecast for growth in 2012 has been revised downwards. The primary reason for the worsening domestic growth outlook is the risk of contagion from the persistent crisis in Europe, which shows no sign of a speedy resolution. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, was 6.1% in November 2011, unchanged from October. The categories of food, housing and utilities, and transport together accounted for 4.4 percentage points of the November outcome. Food price inflation accelerated further to 11.6% from 11.1% in November, while petrol prices increased by 26.4%. Administered price inflation was unchanged at 8.7%. CPI inflation excluding food, petrol and electricity remained unchanged at 3.9%, indicating relatively benign core inflation outcomes. Producer price inflation moderated from a year-on-year rate of 10.6% in October 2011 to 10.1% in November. The impact of the depreciated rand exchange rate is evident in the 15.9% increase in the price of imported commodities. Food price inflation remained elevated, with agricultural prices increasing at a year-on-year rate of 12.1% in November, and manufactured food prices increasing by 8.4%. The inflation forecast of the bank has been subject to a further upward revision. Inflation is now expected to remain outside the upper end of the target range for the whole of 2012, and to peak in the second quarter of 2012 at around 6.6%, before declining gradually and returning to within the target range in the first quarter of 2013. Inflation is expected to measure 5.5% in the final quarter of 2013. The bank's forecast of core inflation, which excludes food, petrol and electricity, shows a moderately rising trend, with a peak of around 5.5% expected in the first two quarters of 2013. The main factor contributing to the upward revision of the forecast is the changed assumption relating to the exchange rate of the rand, which was partly offset by the downward adjustment to the global growth assumption. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University in the fourth quarter of 2011, have increased moderately, but have remained relatively anchored around the upper end of the inflation target range. Inflation is expected to average 6.1% in 2012, compared with 5.9% in the previous survey. Expectations for 2013 increased from 5.9% to 6%. All categories of respondents revised their forecasts moderately upwards for both years, except for business executives whose expectation for inflation in 2013 remained unchanged at 6.3%. The global outlook remains clouded by the worsening situation in the Eurozone, and growth forecasts for the region have generally been revised down amid widespread sovereign rating downgrades. It is now generally accepted that the Eurozone is likely to experience a recession in 2012, but the extent and duration is still uncertain. The increasingly fragile sentiment is exacerbated by the lack of resolution of the sovereign debt crisis and the consequent increase in sovereign debt yields, further fiscal austerity measures in the region, and the impact on the real economy of higher capital requirements for banks and consequent bank deleveraging. Tightened lending standards have also had cross-border implications for a number of emerging market economies, particularly in Eastern Europe and Latin America. Although the OECD leading indicators and global PMIs are trending downwards, the economic growth outcomes in Japan and the United States have been more favorable than was the case in mid-2011. The unemployment rate in the US has declined, and both consumption and investment expenditure have shown some signs of recovery, although downside risks from fiscal consolidation and the continued weakness in the housing market remain. Growth in emerging markets and developing countries, while still relatively favorable, is also expected to moderate somewhat, in part due to the contagion effects from the European crisis, as well as policies which have been aimed at curbing domestic demand pressures. Economic growth in China is also expected to slow, but a hard landing is not anticipated. Sub-Saharan Africa, which has become an increasingly important destination for South African exports, is expected to continue to grow at a rate in excess of 5%. Global inflation appears to be moderating, as weaker demand has contributed to declines in food and commodity prices. Oil prices, however, have been underpinned by risks to supply due to geopolitical factors. The Rand exchange rate has continued to display a relatively high degree of volatility in response to erratic changes in global risk aversion. Since the previous meeting of the MPC, the Rand has traded in a range between R7.93 and R8.60 to the US dollar, but for the past month the range has generally been between R8 and R8.20. Since the previous meeting, the Rand is more or less unchanged against the dollar and appreciated by about 6% against the euro, reflecting the influence of the euro-dollar exchange rate on the domestic currency. On a trade-weighted basis, the Rand appreciated by almost 3% over the same period. South Africa's experience with portfolio capital flows during 2011 was similar to the general emerging market experience of slowing bond inflows and net equity outflows. For the year as a whole, non-resident purchases of bonds amounted to 42 billion rand, while net sales of equities were to the value of 17 billion rand were recorded. The outlook for the Rand exchange rate remains highly dependent on global risk appetite. While the Rand remains vulnerable to global developments, it has been relatively stable in the past few weeks, and consensus forecasts reflect an expectation that the current levels will be sustained for a protracted period. But this is significantly dependent on global sentiment and developments. The outlook for domestic economic growth remains subdued. According to the bank's forecast, the annual real growth rate in 2011 is estimated to have been in the region of 3.1%, but the outlook for 2012 and 2013 has deteriorated relative to the previous forecasts, mainly due to a downward revision to the global growth assumption. Growth in 2012 is expected to average 2.8% compared with the 3.2% in the previous forecast, while the forecast for growth in 2013 has been revised down from 4.2% to 3.8%. This implies a further expected widening of the output gap during this period. Despite the less favorable outlook, some improvement is expected in the mining and manufacturing sectors, which both contracted in the second and third quarters of 2011. Although mining output contracted further in October, it rebounded on a month-on-month basis in November. However, the change in the 3 months to November compared to the previous 3 months showed a contraction of 0.7%. The manufacturing sector experienced positive growth in October and November, with the physical volume of manufacturing output increasing at a 3-month-on-3-month rate of 2.6%. Nevertheless, the sector is expected to remain under pressure. Following 4 consecutive months of increases, the Kagiso PMI declined to below the neutral level of 50 to 49.4 in December. The construction sector also remains subdued, notwithstanding an increase in the real value of building plans passed in November and a slight increase in the FNB Building Confidence Index in the fourth quarter. On the positive side, the sector could benefit from the continued but slow improvement in the growth of gross fixed capital formation, which increased at an annualized rate of 5.6% in the third quarter of 2011. According to the RMB-BR Business Confidence Index, business confidence remains relatively low, having declined marginally in the fourth quarter of 2011. Despite the weak economic performance in the third quarter, employment growth surprised on the upside. According to the Quarterly Employment Survey of Statistics South Africa, formal non-agricultural employment increased by 47,300 in the quarter and by 207,000 on year, with the bulk of the increases in the second and third quarters coming from the private sector. This trend is consistent with that observed in the Quarterly Labour Force Survey. However, the employment losses suffered during the recession have still not been recovered, and future employment prospects remain uncertain given the fragile economic outlook. Growth in consumption expenditure by households continues to be the main driver of growth in the economy, but growth rates remain moderate and are not expected to pose a risk to inflation. Real final consumption expenditure by households increased at an annualized rate of 3.7% in the third quarter of 2011, up from 3.3% in the previous quarter, but lower than the levels recorded in previous quarters. Retail sales grew at a year-on-year rate of 6.8% in November, while on a 3-month to 3-month basis, growth of 3.1% was recorded. According to the FNB-BR Consumer Confidence Index, consumer confidence increased marginally in the fourth quarter of 2011. Consumption expenditure continues to be constrained by relatively tight lending standards by banks, high levels of household debt, and consistently above average increases in a range of administered prices, which reduce the amount available for household discretionary expenditure. The gradual deleveraging by households has continued, with the ratio of household debt to disposable income declining further from 75.8% in the second quarter of 2011 to 75% in the third quarter, compared with a peak of 82.3% in 2009. The decline in the ratio, however, reflects the fact that disposable income is increasing at a faster rate than debt accumulation. Trends in credit extension have remained subdued and more or less unchanged since the previous MPC meeting, with year-on-year growth in banks' loans and advances to the private sector measuring 6% in both October and November. Mortgage advances remain relatively depressed, in line with the weak state of the housing market, and increased by 1.9% in November. The main drivers of credit extension in November were the 6% increase in installment sales credits and leasing finance, reflecting improved motor vehicle sales, and other loans and advances, which increased at a year-on-year rate of 12.6% in both October and November. This category was driven mainly by general loans, which include unsecured lending. The main pressures on inflation continue to emanate primarily from cost-push pressures. Administered prices remain a concern in the inflation outlook. The price of electricity has been an important driver of inflation, and increases of 17.3% are assumed for both 2012 and 2013. However, the current NERSA determination ends in mid-2013, and subsequent price increases are yet to be determined. The case for further significant above-inflation increases is questionable. The determination of administered prices should not act as an inhibitor to growth and investment. International oil prices have been subject to conflicting pressures. Downside pressures have emanated from the weaker global growth environment, while upside pressures emanate from geopolitical factors, which have raised fears of possible supply disruptions. Nevertheless, the price of Brent crude oil has been surprisingly stable and, despite some volatility, is at similar levels to those prevailing at the time of the previous meeting of the MPC. Domestic petrol prices decreased by a cumulative 16 cents per litre since early November, but the current under-recovery suggests that a further increase can be expected in February. According to Andrew Levy Employment Publications, the overall average wage settlement rate in collective bargaining agreements amounts to 7.7% in the first 9 months of 2011, compared with 8.2% in 2010. However, there are indications that the downward trend in nominal remuneration may have reversed. According to Stats South Africa, growth in remuneration per worker increased by 8.6% in the third quarter of 2011 compared with the same quarter in 2010, up from 6.4% and 7.4% in the previous 2 quarters respectively. Adjusting for declining labour productivity trends, this has resulted in nominal unit labour costs increasing from 5.2% in the first quarter to 8.3% in the third quarter of 2011. These developments could pose further upside risk to the inflation outlook. Food prices remain a major driver of inflation, influenced by both local and global factors. Domestic food prices have been negatively affected by the recent depreciation of the rand and a smaller than expected maize crop, which contributed to the doubling of domestic maize prices over the past year. Futures prices of maize suggest that some relief may be expected during the first half of 2012. Furthermore, global food prices have been declining, with the FAO Food Price Index falling by 11.3% in December 2011, compared to its most recent peak in February that year. Nevertheless, domestic food price inflation at the consumer level is expected to remain relatively high for some time. The MPC has reflected on the various risks to the inflation outlook and considers these risks to be fairly evenly balanced, notwithstanding the reality that the exchange rate remains a significant source of uncertainty. The main downside risk continues to emanate from global economic developments. The MPC remains of the view that inflation pressures are primarily of a cost-push nature, but is concerned that a persistent upward trend in inflation and prolonged breach of the inflation target could have an adverse effect on inflation expectations, which could reinforce the upward inflation dynamics. However, the MPC is also cognizant of the slowing domestic economy and feels that given the lack of demand pressures, monetary tightening at this stage would not be appropriate. At the same time, the nominal policy rate is at a long-term low and the real policy rate is slightly negative, indicating a monetary policy stance that is accommodative and supportive of the real economy. The MPC maintains a preference for a stable interest rate environment, given the conflicting pressures on monetary policy at this stage. However, the committee will continue to monitor domestic and global economic and financial developments and the risks to the outlook, and remains ready to act appropriately to ensure the attainment of the inflation target over the medium term while being supportive of the domestic economy. The Monetary Policy Committee has therefore decided to keep the repo rate unchanged at 5.5% per annum. Thank you, and I'm now able with my team to take any questions that you may have. Can I ask you, as always, just to identify yourselves? And we'll start with you, Miriam.
Thank you, Governor. Miriam Issa from Business Day. In the statement from the MPC, a fairly strong case is made for for slowing the increases in administered prices. And you mentioned that the case for this is questionable and the determination of administered prices should not inhibit growth and investment. Is there anything that the Reserve Bank can do about this? Is the Reserve Bank going to talk to the relevant people about this and try to slow the process of price increases?
In the direct sense, no. These are prices that are set by different bodies throughout. So if you looked at education or health, you've all got price-setting bodies. The fact that we draw this to the public attention as well as to the attention of those who are setting those prices is part of the discussion that we need to have about what is driving the inflation in this country and where these decisions lie. Obviously, there's ongoing interaction between ourselves and the different bodies over time during the year. It's not just that you meet them on an occasional basis. There's discussion between the teams that are involved in setting electricity prices and our research team to see the impact. But what we're raising here is that the pressures do come from setting, or some of the pressures, not all of them, but they come from administered prices, and that we raise specifically the question of Eskom in terms of the price setting. So yes, ongoing interaction with them, yes indeed. Yes.
Good afternoon, Governor. It's Renee Volgra from Sunday Times. Governor, at the previous two MPC press conferences, after questions from the press corps, you said there was some discussion on a possible rate cut, although the final decision was a unanimous one. Was there again similar discussions on the possibility of a rate cut given the growth prospects and especially the global risks? And then the second thing I want to know is, what is the bank's position on the downgrade of our rating outlook by Fitch Ratings last week?
Just in terms of whether there was discussion about a rate cut, no. You know, and I wouldn't divide it into, we're now discussing whether there should be a rate cut or there shouldn't be. We have a general discussion, we discuss it very vigorously throughout. So the question of posing, should there be a rate cut, was not an issue this time. It was a unanimous decision. And I want to re-emphasize this question, is that when you consider monetary policy, you actually have three decisions that you can make. You can raise, you can lower, and you can hold. And hold is an active decision. It's not a default position. It's a question of saying that at this point in time, we don't see sufficient reason to raise or sufficient reason to lower. And that given all of the uncertainties, we feel that creating a stable, predictable environment in which there's certainty looking forward, to the best that you can have certainty in an extremely uncertain environment, is the best approach at this moment, given the balance that there is for the country to be able to take decisions. So it is an active decision, not simply a question, oh, well, we're not sure whether we should raise or lower, so let's hold. That's not the approach taken. On the question of the bank's view of the rating agencies, look, the rating agencies, as you've seen, have actually had a pretty broad brushstroke at the moment. It seems to be something that there's been a New Year resolution about what they want to do. And South Africa has had an outlook change, not a rating change, but an outlook change from both Moody's and Fitch. And obviously we take account of what they're saying, the concerns that they're seeing, and it's up to us as South Africa and all of us in our different roles to address those matters. Obviously, in terms of the country rating, we have every confidence in our banking sector. It is very sound, but you will have an impact simply because banks cannot have a higher rating than the country rating. So we take note of what the issues are and what is being raised, and certainly would address to the best that we can the concerns that are being seen, and to ensure that we do what we can to minimize any impact. So we certainly take it seriously. Yes.
Good afternoon, Governor. Nompumelelo Siziba from Summit TV. Just wanted to ask you about the possibility of a Greek default. If Greece and the private sector bankers can't get their act together and come to a deal, and Greece does default, what sort of impact do you foresee this having on South Africa?
I think that it would be inappropriate for us to single out of Europe the impact of a Greek default on South Africa. I think the question, you've got a huge number of commentators around the world who are analyzing every single possible outcome of a Greek default, no default, or whatever the decisions are. Certainly it's a serious situation, but I think that when we're looking at it from South Africa, we would be looking at the impact of the Eurozone as a whole. Because the first impact you would have of any activity in Greece that does not provide a stable outcome and a stable forward-looking will be on the Eurozone. So, and that's why if you looked at the statement we've made, we've expressed our concerns about the lack of resolution, or the slow resolution, slow pace of resolution, and in particular the slow pace of sovereign debt in the Eurozone. You've got to bear in mind that this is not a small event, whether they go into default or not. It's a very challenging environment for Europe, and we would watch it closely. But I don't think, as far as I'm aware, we don't have exposure to Greece at all. But that would be a very narrow look at what's happening. And we look at it as the Eurozone and the implications for the Eurozone, and certainly discuss all of those things. So for us it would be the totality of implications for the Eurozone and then consequences for us, which we've set out. Will be for the rest, for the whole world, there will be an impact. I think the plus that we're seeing, which is important, is that this great recession and its consequences, you've had a very synchronized downturn, the United States, Japan, the Eurozone, the UK. And what you're seeing, and I think that's what we're pointing to, without it being something that we're overconfident about at all. But what we're saying is that you're having the beginnings of a signal that the United States may be growing a little better. And it may be a little bit more. It's a very tentative situation. It is not something that we can, with any confidence, say this is sustainable. But for 2012, it looks better. And the importance of that is not just that it's the US that's growing, because it is a driver of global growth. It's that it's breaking that synchronized downturn where all the countries are going down together. So you've got to have somewhere where growth is beginning to pick up and helps other countries come out of it. And I think that's the importance of what's happening in Europe and the US at the moment. At the back.
Tsepo Moy, SABC News. When back on the issue of ratings, when Moody's revised South Africa's outlook, you indicated that you will try to engage them and find the reason behind their action. What I want to find out is, in your deliberation, what are some of the arguments that they raised and how did those discussions go?
No, I don't think it's appropriate to discuss what Moody's raised. It's an ongoing interaction with us. They've put out very clearly in their document what they see and what their concerns are. So it's a question for South Africa to look at that and see how we address those challenges. And there is obviously, as we've said, from the country and from ourselves, ongoing interaction with Moody's around these issues. So, I don't think we would elaborate on what they've put in their note. They've set out very clearly their concerns. It's up to us to look at that and see how we tackle them. There was also a hand at the back there. If I missed somebody. Miriam?
Thank you. I've got two very closely related questions about the Rand. In the previous MPC statement, it was said that the Rand is likely to appreciate this year. I just wondered if the MPC still holds this view. And I noted that in the upward revision to the inflation profile, it was said that the main reason was the Rand's depreciation. And yet the statement says the Rand has actually appreciated between the last meeting and now. So I just wondered if you could, explain that apparent discrepancy, that the Rand is a bit firmer than the last meeting, and yet your inflation outlook has gone higher.
I think that if, for all of us in this room, and I'm going to ask my colleagues to address this as well, but for all of us in this room, I would defy you to tell us where the Rand will be in a few days. So that in the forecasting model, we've looked at what an assumption would be about where the Rand could go. And that's what we're saying, is that in that assumptions in the model, it looks at inflation being higher because of that assumption. What we're also saying is that the Rand has retraced its steps over the last few weeks. And therefore, it's been trading at this level and may well have contributed or contribute. If it stays at those more appreciated levels, it would contribute to the inflation outcome being slightly moderated from what the forecast or the modeling says. Because the modeling is interpreting, it has put in where it was before. So it's not a discrepancy. It's two different things. It's what your assumption is in the model as a weaker currency and what the currency is currently trading at in the band that it is. But as we know, this is not something that any one of us can say that it'll be the same in the next few weeks. So obviously it has that outcome. So that's the questions there that I would address. But perhaps, colleagues, you'd also like to address the question of appreciating this year. I'm not sure that we have... Look, the issue around appreciation and depreciation needs to be taken account of also, in that the reasons why you've had huge capital inflows into emerging markets have not gone away. What you've had is a risk aversion which has seen a flight of capital across emerging markets into, and that's not, and advanced economies, because obviously there's been a huge flow out there, into what is primarily the dollar. In that sense, the returns that you're going to get and the need for those entities that were investing in emerging markets to meet their liabilities has not gone. So at some point in time, our expectation is that that will turn. Now, what that timeline is, nobody knows. But the reasons for it occurring, with all its problems, have not gone away. But perhaps you'd like to add. Yeah. At the back.
Governor Kola from Reuters. Food inflation is at about 11.7% here.
Sorry?
Food and beverage inflation is about 11.7% in November, from 1.3 in this time in November the year before.
Yeah.
And you've given the weak rand and a small maize crop that's expected as the reasons. Does that mean if the rand appreciates that we'll see a stem in the rising food prices?
Not automatically, but Rashad, can I ask you to deal with that?
Look, it depends. I mean, if the rand appreciates, some food prices come in much cheaper. So obviously, an appreciation of the rand is very benign to inflation generally. Obviously, what has happened in the food market at the moment is that there's been a number of maize has been exported, and that has caused an appreciation of food. But generally, appreciation means that things are much cheaper, but it has other effects which we can discuss later on.
It's not automatic that would happen. I think that what you're also seeing is it depends on weather conditions, food, and what you're seeing globally is that there is a decline in food globally, and there's usually quite a lag between that decline and what we see in our own economy. But we say here quite clearly that we expect food inflation to be with us or higher food prices to be with us for some time. I think it's at the back.
Governor, a question via the webcast from Razia Khan. Given the weak credit growth, despite a prolonged period of accommodative monetary policy by South African standards, does the SARB have any broader concerns about the efficacy of monetary policy in providing an economic stimulus?
Who would like to respond to that?
I think that the MPC statement is very clear, that we believe that the current stance is sufficiently accommodative. And Razia's question is whether we believe in the efficacy of monetary policy to provide any stimulus. Well, I think that is what we had just done by keeping the rates where they are. We are saying that it continues to provide a stimulus to the economy, and that we see no reason to change the stance that we have.
Other questions? Yes, sir. Just lift that up. Lift the flap up. There we go.
In your delivery, Honourable Governor, you did mention that towards the first quarter of next year, we'll see inflation coming back into the band. I'd like you to just elaborate more on what drivers are you expecting to drive the inflation into that band.
I'm going to call on colleagues as well. I don't know, Brian, if you'd like to address that one.
Yes, I think going forward, obviously we make a number of assumptions about the evolution of certain of the exogenous variables. So, for example, the oil prices are an important assumption, and we also have assumptions about, for example, the exchange rate. Now, if for example, with the oil price, we have seen an increase in petrol price, an increase in oil prices, and to some extent we expect to see some stabilization of the global oil price. So we don't necessarily expect global oil prices to fall, but to stabilize at more or less at current levels, not necessarily exactly the same levels, but it does mean that the rate of increase and therefore the inflation rate relating to oil will come down, and that should have a moderating impact on petrol prices and administered prices in general, because petrol is one of the administered prices. So there are a number of these variables where we think that the the previous high dynamics of price increases will either stabilize or reverse. I think with respect to food prices, we would expect to see some moderation coming through in the food prices as well, which is likely to have a moderating effect on inflation. At this point in time, we don't see significant demand pressures coming through, as we've indicated. We do see some pickup, as we said, in underlying inflation, but we don't see very strong demand pressures. So all of those together add up to a moderation of those pressures that we believe are driving inflation outside of the target in the first place, which, as we indicated, were administered prices and food and petrol in particular.
Want to add one bit?
Can just add to what Brian has said. You should just remember, don't hold us to say that when we come in, we don't come in to the 5% level in the first quarter. We said this time around. It's based on the assumption that is made, and it's just a forecast. So it's I don't say it's not likely that we'll come back, but based on the assumption, we think that at this meeting will definitely be within the target range in the first quarter.
Eskifilo from Unisa Radio. In the wake of the Eurozone debt crisis, it seems like we are sitting between a rock and a hard place. How do you manage to keep the inflation, the target range of 3 to 6%, and yet at the same time managing the economic growth?
Well, that's what we've tried to set out here, is to say that, our mandate is price stability in the interests of sustainable growth and development. And if it was simply a question of inflation is rising and it's out of the band, and we think of ourselves as, if you like to use the expression used, inflation nutters, you can raise interest rates and you can try to get it back in the band. Part of the challenge that you have here is what is driving inflation is not affected by the where your interest rates are. We could raise interest rates significantly and we will not impact on the inflation that an electricity price increase of 17.5% brings. It's not driven by that. So what is happening with inflation, it's driven by things that are not areas that interest rates or the Reserve Bank has an impact on. Doesn't mean you ignore them, because obviously they go into second round effects. So what we're saying is that we expect inflation to be above the target, peaking at 6.6%, above the target, and come back in 2013. We see that as a forecast of what we think would happen, because our view on the band is that we need to have a medium-term approach to it. It's a constantly forward-looking question. And therefore, we're recognizing that as we're tackling that inflation growth, we're also not acting in a manner that if we had to hike interest rates extremely in a narrow definition sense, it would impact on growth, and we are concerned. So you're quite right, it's a balance between the two. Without us being soft on inflation, we're also saying that you've got to take account of what your steps that you can exercise impact on, and we don't see the demand pressures. And that's why we've taken the stance we have, because it is trying to balance between the two. And that's a very difficult situation to be in. So that's what the balancing act that we're trying to achieve, is to address both. Yes.
Governor, how do you think South Africa should address issues of lower productivity against rising wages, which you say could be the next thing to drive inflation higher?
Well, we're saying it can be. If you've got the question of rising wages and declining output, you've got a problem. It's not the absolute level of wage, it's what happens in the system and whether productivity is ahead of what your wage increases are. I think South Africa needs, in my view, to have a very serious look at the challenges we face and the opportunities we've got in the global crisis that we have. And all need to come to that party, whether it's government, whether it's civil society, whether it's labor, whether it's business. We need to put our heads together. This is not a short-term question. This crisis in the advanced economies is entering its 5th year. If nothing gets worse, you've still got quite a number of years to go before you come out of it. South Africa has great opportunities both within the country and in the region. And if you look at the expected growth rates of, say, the emerging Asias and so on, and the African continent, the sub-Saharan continent, we're looking at 5.5% on the continent. This is an opportunity, a huge opportunity for Africa to look at what we can do and to ensure there's growth, and South Africa is part of it. So I think I wouldn't want to see it in isolation. I would want to say that as a measure for a country response to one of the worst economic situations that the world has seen, we need to examine all of the issues that we face and put things on the table so that we can have a country response that creates South Africa on the continent and part of the continent as a real option of where we can look to for the future. So there are big challenges ahead for us, but big opportunities. Miriam.
Thank you, Governor. Just one more question. The Federal Reserve has indicated a time span over which it expects interest rates to remain very low. And I was wondering if the Reserve Bank could tell us something similar. How long do you expect rates to be slightly negative, or how long do you think the nominal rate should be low?
Who would like to answer that one, Mariam?
Well, it's not an ideal situation. I mean, we're not happy also, if I can take a bite on it, to have sustained negative real interest rates. One is of the opinion that if we get out of the environment that we are in or that we are facing, definitely the economic activity will normalize, and as a consequence we will see also some positive real interest rates. Definitely they're not good for savings, and if you do not have savings also they cannot contribute to activity. So we're just hoping that economic activity and things will get better, and therefore we'll come out of the situation.
Does anyone want to say anything? Look, the reality about these issues is you want as stable an interest rate environment as possible, and you want it appropriate for your country. If we've got inflation levels that we have, and we know we don't go below a certain level, even if we looked at where we got to sort of the lower end before it turned was about just over 3%, if I recall, 3 point something, which means you've got a structural problem. Here you've got a situation in the US which, they zero bound and going with quantitative easing and all kinds of questions. They've got a very different challenge to what we have. And it is the measures they're trying to take. I mean, they're talking about whether they should introduce inflation targeting. But they want inflation targeting to enable them to have some inflation. It's quite a different story. So if you have inflation targeting, you're aiming at having a 2% maybe, or whatever the number they say that they're going to have or they're going to aim at. So they've got a very different environment that they are dealing with. I think that every country tries to look at what is appropriate for ourselves, what is achievable for ourselves, and what's good for our economic circumstance. We must recognize our real policy rate, and has been for some time, is slightly negative. It's an accommodative stance that supports the real economy, and that if situation changes, we will have to act appropriately, and we would be unhesitant in doing so. I think it's the approach taken by the Fed we will watch with interest, because they've done a lot of things, if you look over the past few years, that would not be appropriate for us to do at all.
Governor, just a very brief question. It relates to credit extension. We know that it's been fairly stable at around 6%, but reading articles and hearing from financial institutions, there seems to be a massive rise in unsecured lending. How concerned is the Reserve Bank about that?
I'll give a very brief answer, but I will also ask the Registrar Renée van Wyk to deal with that. Look, when you're looking at what is growing in unsecured lending, you've got to look at the size in relation to the total. And it's still a relatively small percentage. It is something we're watching. It is something we want to understand better as to why it is developing the way it is. but it's not something that one should say, oh, we've got a real problem brewing here. The people who've been involved in unsecured lending, your Capitex, your Ables, have been doing this for a very long time, and they're very seasoned and experienced within it. The growth in unsecured lending in the commercial banks would be something that we are looking at. But it is a factor, it's something that is there, but you've got to look at it in the total lending and you'll see that it's not that big. But it doesn't mean that we are not watching it. But I'd like Renee perhaps to address the question. Renee.
Governor, I'm going to find it very difficult to add to what you've said. It basically captures the situation quite adequately. The growth that we've seen are in the banks that have been doing this for a long, long time and are very sophisticated. At this moment in time, there's nothing that we are concerned about. We will monitor it, but we are comfortable.
I think, though, that it's also been important that this has been raised in the public domain. So there's an awareness. I mean, your best protection is knowledge by the public that if you're getting into things like unsecured lending, understand what you're going into. And again, part of the plus of it is it's taking place in, if you like, a regulated environment. There's the National Credit Regulator, there's the Usury Act, there's a whole lot of things that in doing unsecured lending from the formal sector, you've got to comply with. If you take that by comparison to sort of your loan sharks, you've got a very different rate of interest, but also a very different environment. This still becomes part of people's credit history and so on. So yes, watching it, but the fact that it's occurring in the formal sector, I think allows it to be, to get a better understanding of exactly what's happening, but also in the interest of consumers, it's within an agreed frame that it can take place. Anyone else? Am I missing anyone? Anything you'd like to add, anyone? Thank you all very much. Thanks for coming through January, and we shall see you again in March, if not before. And all the best with a very challenging year ahead for all of us. Thank you very much for your support of the Reserve Bank and the interest in what we do.